there are some significant differences between 1987 and now. The first is that the central bankers are a lot more aware, a lot more interconnected than we were in 1987. So really at the moment we're not seeing that sort of scenario. This is very much a technically related sell-off. Yes, it is true that the markets are going parabolic, and we had told people that markets don't go parabolic forever. That's almost a truism. But what we were thinking was that, or what has actually happened, is that there has been some issues in the volatility markets in the U.S. If you look at things like the VIX has spiked to the highest level since 2011, effectively there's a very significant short squeeze going on in the U.S. volatility markets that necessitates then, as a partial hedge, selling of futures. So what we've been seeing is that continued selling of futures that's happening. This sell-off is very futures-led as opposed to cash-led. Our pads across the region are actually slightly better to buy for the day. Saying that, we've been advocating that the market was vulnerable to a 13% correction, and that 13% is now emerging. We think that people should wait for a little bit longer. We think somewhere a close of below 24.85 on the S&P futures will be a significant level that will feed back into things like the Fed model, at which some action will be taken. So for the time being, we're remaining longer-term constructive, but we're waiting for the appropriate buying opportunity, which may be around 3% below where the market is currently trading in the U.S. equity market. Some of the emerging markets, though, we think have got a bit further to go. So maybe another 6 or 7% in some of the emerging markets. So maybe later this week might present an interesting buying opportunity to step in.
So Mohammed, net-net, you're saying that don't try and catch the falling knife. Wait for things to settle down. Once you do see the first signs of stability come by, some consolidation at least in the market, that's when you should jump in?
Not necessarily. I think where the markets are right now will require some form of calming measures. Now, whether that comes from a statement from the Fed or it comes from central bankers acting together or whatever that is what we are on very high alert for right now. Certainly, the only thing we've seen so far this morning has been a proposal by the Korean government to defer capital gains. I know capital gains has been a big issue in your market, and that's one of the reasons why we've been concerned about India as well. But we do think that you wait for the signal. Once we get down to this big decision level, which we think is another 3% lower in the S&P futures, then we'll have to wait and see to see what happens. Now, at the moment, that's our base case scenario. Of course, if that doesn't happen, then it's possible that all the gains from the Trump rally will evaporate. But I think what this will do is it actually shows the fragility of the global recovery. So global equity markets have really been pricing in this idea that the global economy had reached a takeoff velocity that they could do without the central banks. And we're now finding that maybe that idea isn't as right as some people thought it was. And it may be that bond yields will actually continue to come down. We may have seen a short-term high in bond yields.